is different this time about a record pullback in bonds, price down, yield up?
Yes, that's right. And actually, there hasn't been any place to hide as far as a safe haven. If you look at corporate bonds, investment grade, junk bonds, even treasuries, everything is down about 10 to 12% total rate of return. So almost to some of the better equity sectors. So it's really been no place to hide so far.
How do you get optimism amid the stomach-churning volatility that you have been seeing, Margie?
Well, I think what's happened is the Fed, having been sort of comatose when rates were low, the danger signals are starting, has now talked very, very tough about aggressively raising rates, aggressively selling down their portfolio, and it's really scared the market to death. They've only made 75 basis points of rate increases in the short end, but if you look along the curve, bonds are up in yield 120 to 150 or 60 basis points, so the market has raced ahead of the Fed, anticipating the Fed to be very aggressive in their action. That's starting to roll over into the real economy and certainly into the equity market.
Margie, there is a belief in markets that is pervasive that the Fed will step in at some point, that they will take notice of the carnage in some of these equities, and they will actually stop some of their hiking. You are one of those people who does believe that, but we have seen no signs of it. What gives you such confidence on that front?
I think reality will awaken them. I think they've been maybe a little bit too attuned to Wall Street saying we need much higher rates and ignoring what's going on in the real economy as far as consumer inflation, signs that we're actually seeing employment start to roll over. And those are worrying signs, and I think the Fed will see them. Typically, they lag the reality of the market, but hopefully they will see that they're beginning to do damage to the real economy, which is in pretty good shape. The excesses have really been in the zero interest rate part of the market, the equity market, the housing market, other real asset markets.
Margie, I want to talk about coupon right now. The coupon has changed. The yield to maturity has changed. For our audience on radio and TV, what they're gambling on is I'm getting a higher yield now, no question about that, but I'm worried about price decline. How do you balance the greed of grabbing that higher yield versus the fear of bonds continuing south?
Well, I think we're very near the peak in interest rates, frankly, because of I think the economic setters are going to be beginning to roll over, and the Fed will stop what they're doing. And really, when you look at high-yield bonds yielding 6.5% to 8.5%, trading at 90 cents on the dollar, for a longer-term investor, meaning a year or more, that looks like a pretty reasonable risk-return alternative. Frankly, it may do as well as the equity market, which we think will just be mid-single-digit to low double-digit.
So to be clear here, and let's be clear, Margaret Patel is acclaimed worldwide, folks, for a truly balanced outlook on equities and bonds. Did I just hear you say bigger appetite for yield and longer duration yield versus buying a dividend growth story?
Well, I think there's always going to be more money to be made in equities over the long term. But over the, say, the next year or so, especially if you're interested in income, not capital appreciation, corporate bonds, especially high yield, I think are really pretty attractive on a risk-reward basis.
Margie, what do you have to see in order to actually achieve this in terms of a downturn? A lot of people baking in a recession. We are seeing that certainly baked into a lot of valuations. You're basically suggesting that's off the table and high yield is still the place to hide.
Well, I'm assuming that is a big risk that the Fed doesn't get the markets, the real economy signals, and keep marching along with a very aggressive tightening program. But if they look at the real world out there, I think they'll see it's time to take a big pause. And I think at that point, we will more or less evaluate the market and perhaps be able to see a way through without a recession. If the Fed keeps doing what they're doing, we may very well have a recession at the end of this year or in 23, precipitated by their actions, as well as global weakening. There's a lot of negative things going around in the world away from the U.S. that could really drag the U.S. market down from here. So I hope the Fed will look around before they get too aggressive.
Margie, why haven't we seen more substantial outflows, in particular from bonds? We have seen some, but why hasn't there been a stampede away from an instrument that should be full faith and credit and should be rock solid?
I think one of the reasons is because if you look at the yield on money markets, it's still very, very low, so it really isn't a competitive place to hide. It's not as if you could get 3 or 4% in money markets and say, fine, I'll stay there. You're still looking at best something maybe approaching 25 basis points. So I think people are inclined to say, we've seen this volatility before, we're going to stay where we are. Or those people who've gotten obliterated in some of those equity names that have blown up, or maybe don't have anything left to sell, or just sort of frozen, not sure what to do in this market.